welcome to Smart Money. On this show, we guide you on how to make the most of your money and build wealth. So let's have a look at what we have on the show for you this week. Tax-free bonds, are they still a smart investment choice? And as always, we help you with your financial portfolio inquiries and guide people who are looking to shift abroad as to how to manage their finances. We have seen slew of tax-free bonds this financial year and few more in the pipeline. With the interest rate in a downward spiral, they have managed to offer some promising returns. But do they still continue to be an attractive alternative amongst various tax-saving instruments? Let's find out all that you need to know about tax-free bonds from Hemant Rustagi, CEO, Wiseinvest advisor. Hemant, thank you so much for joining us. What is it that makes tax-free bonds really stand apart from other tax-saving instruments?
Well, Priya, as far as tax-saving bonds are concerned, as an investment option, I would say I think it's one of the best options, especially for all those investors who are looking to invest in an investment option where they want their capital to be safe and they want money to put aside for longer period, maybe 10 years, 15 years or 20 years. And also for those who are looking to earn interest, which is tax-free. Now, what these tax-free bonds are offering here is that, these are issued basically by the government organization. So one has a reasonable amount of capital safety. The interest which is paid is completely tax-free, which means that if you look at a tax-free interest of, let's say, 7.5%, for someone who is in 30% bracket, the pre-tax is going to be around 11%. There aren't many options where your capital is safe and you can earn around 11% pre-tax. So I think as an investment option, I would say a pretty good option, but I must clarify two things here. One, when you invest in these tax-free bonds, it's only the return which is tax-free. There is no tax assumption on the capital or the amount that you do invest. And the second is, even though, like I mentioned, that it's a great option for investment, before investing in them, I think it will be advised that every investor should look at what his or her requirements are before investing in these bonds. One should be investing in these bonds just because the interest that you earn is tax-free.
Hemant, if you were to sort of compare it with a fixed deposit that offer tax-free returns and with these bonds, where do they stack up? What really is the difference that really happens in terms of the two categories?
Well, I would say I think on the safety parameters, I would put them both on par because even the bank deposit is quite safe and the safety of capital here in these bonds is also there. But I think the basic difference is that generally when you invest in fixed deposit, especially for tax saving purposes, you invest for 5 years. Here are these bonds which are for 10, 15 and 20 years. It's very difficult to find instruments where you can be sure of getting a fixed return for such a long period. Because what typically happens with a debt investment is the major risk is risk of reinvestment because you don't know how the interest rates are going to be. So if you're looking to park or invest some money for longer period, like 10, 15, 20 years, definitely tax-free bonds score over fixed deposits.
Hemant, we are right now in a pause mode as far as the interest rate cycle is concerned. And secondly, while the government has made it amply clear that it is looking to revise various saving schemes and need to look at regularly monitoring and looking at the rates that are being offered, in light of these two factors, how do you see tax-saving bonds really, stand up in terms of currently, if you see savings, different saving schemes are still promising some very attractive returns?
Well, Priya, as far as these tax-free bonds are concerned, one, it's important to know that these bonds were basically announced in the budget last year. So, the budgets will be on tap maybe by till 31st March this year. You have two more organizations, I think, which are going to be, apart from IRD, EDA, which is going to be open soon, two more organizations that will be issuing these bonds. So clearly, as far as the interest rates are concerned, as you rightly mentioned, I think there is a pause. I'm not expecting any more rate cut from RBI, definitely by the month of March. But I think it's equally important to understand that the interest that these bonds offer depend on two factors. One is they're linked to basically 10-year GSEC paper of that similar maturity. Now, what we have seen is that despite that 1.25% rate cut by RBI last year, the yields haven't really fallen, have not kept pace with that, or have not fallen in that same proportion. So clearly there is an expectation that over the next couple of quarters you'll see maybe at least next quarter at least, you'll see the yields coming down. So that may impact, especially for those bonds that will be coming, let's say in the February or March. There could be some impact. I'm not very sure whether that will really happen or not. So clearly that is one factor to be looked at. The second factor is also the rating of the bonds. Now you have AAA rating and you have AA plus or that kind of rating. So there will be some variation in the interest that these bonds will offer. So these are two factors to be looked at. But like I said, up to March, this is an opportunity for all those investors who are looking to invest money for a longer period in an investment option where the capital is safe. But I will again reiterate that investors must look at suitability. I mean, it should not be that you're just investing money because you're getting tax-free free bonds.
Hemant, just to bring certain examples in terms of the way we've seen the NHAI tax-free bonds, not the entire retail category was not really something lapped up by the investors. The coupon rate, of course, was slightly lesser than what we are going to see as we speak with regard to IREDA. But of course, there is change when it comes to the rating. So in terms of retail investors, you've already highlighted, but what are the key things that you need to weigh when you're looking at investments in these bonds?
Well, I think rating does matter when you're investing in any bond, but considering the fact that these are all issued by the government organization, I don't think it really makes a big difference whether you're looking at AAA or AA plus. In terms of safety, the fact that AA plus rated bond is offering you slightly higher, you can certainly consider investing in them. So I think from that point of view, I don't think investors need to really worry too much about it. But besides that, clearly, I mean, I would say that someone who's looking to generate income on a regular basis or a yearly basis, tax-free bonds can be a great option. But all those retail investors who are looking to, kind of grow their capital over a period of time, I don't think tax-free bonds are a great option. The problem with tax-free bond is that every year they pay interest, which means you don't get the compounding benefit which you generally should get when you're investing your money for 10, 15 and 20 years. So imagine someone who is looking to build up capital investing lump sum money. One, you need to have a lump sum money to invest in these bonds. And the second is that, when you get interest on a yearly basis, and if you're not alert enough or you're not active enough to reinvest those somewhere, now what will happen is if you end up spending that money, after 10 year, 15 year, when you exit from these bonds, you may still get your capital back. So I think someone who's looking for growth, I don't think tax-free bonds are a great option.
How should one be going about investing in tax-free bonds in terms of process? Could you guide investors on that?
So once you've made up your decision, there is a form to be filled in, so which is a fairly simple process. But my recommendation would be that anyone who is looking to invest should be investing on the day one itself, because even though in some of the bonds which are of larger size, the entire portion that was earmarked for retail was not maybe utilized, but issues which have smaller which are going to be mobilizing smaller sums of money, like IREDA, if you look at, you should be investing on the first day itself, because it's first come, first serve basis. So clearly what happens is that if they decide that the first day the issue gets oversubscribed, to at least all those investors who put money on the first day will get some proportionate allotment. So that is something that every investor must keep in mind.
All right, Hemant, with that, thank you so much for joining us as always and guiding viewers as to how they should be going about weighing the option of investing in tax-free bonds. Well, time for a quick...